if you plan to 95 and you retire at 55, that's 40 years.
You're going to be retired more than you were working. I mean, think.
Absolutely.
And you need your money to work for you.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
And John.
Good morning.
And we've got a lot to talk about today.
Yeah.
I'm going to start off with one of the questions. We've been going through this for, a month or so now. The last 4 or 5 episodes where we kind of address one of the most common questions that we get from listeners or, prospective clients or clients. And then we're going to talk a little bit about the Fed, which I'm tired of talking about the Fed, but they always give us stuff to talk about. So, anyways, y'all having a good week?
Yeah.
Football season.
Oh, love football.
It's a great time of year. Weather mornings are cool. Football is here.
It's a good time of year.
Yeah, I don't have a catchy way to end that sentence.
No.
But
It's all good. Yeah, you're
just
right.
a great
fun
time of year.
Hey, one thing we always ask people at the end, but if you like our content, like to hear more, like, subscribe, thumbs up, whatever platform you're on. We're trying to gain more and more subscribers and listeners and viewers.
Yeah, we were talking about right before we got on here how we've
Yeah.
I mean, we've been doing this for a long time, but but it started to grow and
It's
have
grown
more
a lot
listenership.
since I've started to be on these. Have you
Yes.
guys noticed
Yeah,
that?
there's no
I mean, it's just
correlation.
massive
But the
growth.
but it's been fun, and we were talking about how the comments can be brutal, which is always fun. Always.
What do they say? There's
listening
no
to the
such thing
haters.
as bad publicity. But
Right.
maybe there is. But anyway, like, subscribe, tell your neighbor, tell your friends.
Yeah, we have fun.
We like to have fun. Yeah.
Yeah, we have fun. This is very different than what we do kind of in the normal day-to-day parts of our job. So we like to just kind of have fun with this and have a good time. So it's pretty laid back. So the question that we're going to talk about today is, how should I be invested as I get closer to retirement? So it's a great question, something that we hear a lot. A lot of people are they're getting to the age of 45, 50, 55, depending on kind of when your targeted retirement date or age is. You start kind of wondering, like, man, am I invested appropriately? Like, should I be more aggressive, more conservative? So I have a lot of thoughts on this,
Me
but
too, yeah.
kind of open it up. Lee, start us off. Like, what are your initial thoughts when you hear that question?
My initial reaction is it depends. I've got it depends on what the needs are of the client. But yes, it is a very common question. It's just like the question of how much do I need to have. It depends. I mean, I met with somebody yesterday that is getting ready to go into retirement, that with the pensions that he has, or they have, he could literally go into retirement and not have a dollar in investments,
And I think that's
go ahead.
No, finish.
No, I was just going to say, I think historically, people think that I need to get a lot more conservative. Mm-hmm. I need to have less in equities and more in fixed income as I get closer to retirement. Whereas in a perfect world, that may make sense, but we all know we live in a very unperfect world. And so, I do really think it depends on the specific client, what their needs are, their risk tolerance. A lot of people's risk tolerance doesn't change just because they are 5 years away from retirement or even going into retirement. That doesn't mean that all of a sudden I need to shift from 70% equities to 50% equities. So, a lot of it depends on that specific person.
I think the one biggest variable is how dependent are you going to be on your portfolio for income?
Yes.
You kind of said that in a different way, but and the secondary part of that is how flexible are you in your income needs?
Yeah.
Like, are you just solving for the bare minimums where, hey, this is what I have just to literally keep the lights on and feed my family and do the things I need to do? Or Do you have a lot of extra discretionary spend built into that budget that you're planning for that you could adjust if market conditions allowed? And so that's kind of the number one thing is for me is like how dependent, because if you have between Social Security, if you're that age yet, or pensions or rental properties or passive income or whatever it may be, you have enough income coming in, like you may not need to change anything in terms of how you're invested, right? But if you are going to shift from, okay, I've been contributing to these accounts, not relying on them at all, and then all of a sudden I'm completely 100% fully relying on these accounts to produce 100% of the income I need, then yeah, there's probably some differences in terms of how you should invest.
I'm going to date John and I as far as our age, but when we first got into this business, you know, in the fixed income bond world, you could go out and get 8, 9, 10%, you know, interest rates. Okay. And so it made sense that as people neared retirement or were in retirement and needed income, well, they would move money from equities, low yielding investments, to fixed income. Well, for the bulk of our career and probably all of Matt's, interest rates have been, you know, in the low single digits. And so that was not the place to get income. So it has changed. And that was my point as far as like, you know, it depends on the client, your comment on, you know, how flexible they are with their income needs. So it has changed dramatically.
Well, you know, when you look at 401k plans and they have those models that are geared to when you retire, 2030 models, 2035, 2040,
Those
on
target date funds.
Target date funds, which I think are fine, but I also don't agree with that very much at all because, again, the tradition is, like you said, it goes more to bonds as you get closer to retirement. That's what those target date models do. The closer you get to that target date, the more you're going to have in fixed income. And like you said, the last 15 years or so, that has not worked, or it hasn't worked very well. I also say, like, we're living longer than we used to as well. So when we plan for clients to live, we don't know. God only knows when we're going to leave this earth, right? So if you plan to 95 and you retire at 55, that's 40 years.
You're going to be retired more than you were working. I mean,
absolutely.
And you need your money to work for you, right? I mean, so a lot of times, and again, I think it goes back to each individual person when they come in for, or a couple or, you know, family, come in for a financial overview and a plan, and we go through everything from their timeline to their risk tolerance to their you know, what do they need? Last thing I'll say on that. Let's say we do a full-blown financial plan and the client only needs 4% return on their money to make it the rest of their life, and all of their goals are met by doing that. Well, obviously, we would encourage to take less risk, right?
Sure.
Because we don't have to take risk. But you could have to do the same thing, and it might need 8%. So it doesn't matter that you're 60. If you are planning to leave money behind, you want to do all these things, and you're comfortable with the market, you might be invested in the market throughout your entire life.
Yeah.
And that's okay, too. So I think it's individually based. But also, last thing, when we get close to retirement and we get that magic number of, you know, people say 1 million, 2 million, whatever that number is in your head, and you get there and you're 57 and you're going to retire at 60, you should look at your entire portfolio and your entire risk profile and what you're going to need and really do a deep dive, because one mistake that can be made that we saw in 08 was folks leaving their money in the market gets crushed, and now their retirement plans are crushed. So I think you should know.
Yeah, one thing that's not specific to the person is as you get older, your time here on earth gets shorter, right? We can all agree on that. And so hopefully the investment lessons that need to be learned, the hard lessons that we've all gone through, hopefully you've learned those in previous years. Like, now is not the time, as you're asking yourself, hey, I'm getting close to retirement. Now is not the time to be experimenting or try new things and learning the hard lessons of investing. It's more of the, hey, what's tried and true, what works, what are my goals, what are my needs, and running through those. And, you know, I've talked about it here on the podcast before. You can Google this. This is a very, you know, a lot of people use this, but the retirement red zone, it's 5 years before retirement, 5 years after. And if you just look at kind of in the general scenarios for the average person, like when is, you know, someone who's fairly dependent on their portfolio for income, when is kind of the worst time to experience major events, market events? It's in that retirement red zone, because you're transitioning from working, your time horizon to retirement is very short. Then let's say you're in the back end of that retirement red zone, so the 5 years right after you retire, your time horizon is the longest it's going to be while you're in retirement, right? Because you just retired. And so I think, investing in your approach can change. It's not like this standard, hey, I get more conservative as I get older. Like I think there can be a situation where it makes a lot of sense to be a bit more conservative for a specific period of time. And then as we get further into retirement, our time horizon is shorter, and if we've done well and the plan has worked, and then maybe we can be more aggressive because our time horizon is shortened. Most people don't think that way.
Yeah.
But so I think it can be all over the map in terms of how you should be invested. The one thing that you don't want to do is here's the reality of it, and we unfortunately have to tell clients this all the time. If you don't have enough money to retire, there's not a rate of return that's going to change that.
Yeah.
So you have to make the decision. Do I go for broke and be super aggressive knowing that that's still not going to solve my problems? Or am I more conservative and just try to make it last as long as possible? Right. And so I say that as an example to say, the one thing that can blow you up if you're not in that situation is being too aggressive and just getting absolutely destroyed early in retirement unnecessarily.
Correct.
Well,
Right.
I'd say something on that. I had somebody come in a year ago or so, and their 401k was just ripping and roaring like they have been, right? And the market's been great and everything's been great. And they just thought, and I had this really long, deep conversation with them, that is just the way it is, right? If you're in the market, you just win always. Because we have not had a massive pullback since the 2008 financial crisis. That is a long time ago. So a lot of our clients coming in, they've had 10 plus years, 15 years of just robust returns. And I think that becomes the expectation, and that is not necessarily, so you could be taking more risk than you really should, or you're even comfortable with, and you don't even know it, right? Until we have that one event. And that's my point about just know your number, what you need to make in return to make it through life. You can always take more risk than that, of course, but know what situation you're in, and then, have advisors helping you out through that time. Have planners helping you out. So anyway, that's my last point on that.
So we've been talking about the Fed for literally years. I mean, it's just like we can't get away from it. But they've got a meeting coming up.
Next week? Is it next week?
16th,
Yeah,
17th,
next
I
week.
think.
Yep.
So meeting coming up. The market is fully pricing in a quarter base cut, right?
100%.
Yes. Well,
I mean,
you don't.
you
get
want
higher
to see a market go down?
Oh, yeah. Yeah.
They
Okay,
don't.
so the market's pricing in a quarter basis point cut. Two questions here. One, do we think that's what's going to happen? And then two, how do we think the market reacts depending on what the Fed does? So,
Well, if the core
No,
point,
no, no.
oh yeah, sorry.
no, you jump into number two.
Oh, yeah,
number
yeah.
one, do we think?
Yes.
Oh yes.
So they're going to cut
Yes.
it. You don't think it'll be 50?
I think it could be 50. There's a
No.
less chance.
Okay.
Yes.
So you
I think it'll be
quarter-
25.
You think quarter, but 50
Yeah, I
is
mean,
on the
I
table?
would go quarter is the most likely, 50 would be the second most likely, and
Okay,
nothing
thank
would
you.
be the third most likely.
Thank you for clarifying.
Okay.
Yeah.
Yeah.
Okay, so let's say the Fed cuts a quarter basis points because that's consensus. That's what everybody's expecting. What does the market do?
It wouldn't surprise me if the market sells off a little bit.
Yeah.
I don't think we're going to have a
Status quo, in my opinion. Like
Yeah.
it's been kind of floating around here.
I think that typically you buy the rumor, sell the news, and I think the market has priced it in. I think that we've had a pretty good run up to the meeting, and I think I think the market will sell off. But here's what's interesting. If we were to get a 50 basis point cut, I could see a short-term pop, but then
I think the market
people would view that as there's something going on
Yeah.
that's a lot worse, and I think you could see the market really sell off. So I kind of agree with John in the fact that 25 basis point cut, but I do think the market sell off on the news and then reprice and then continue going up from there. I'm telling you, Powell's comments afterwards will be the telltale, and I still think he's going to play his cards close to the vest. I think we get another one. When's the next one after that? Is it November? Do we skip October?
I think so.
I think we get at least another cut before the year end. There's more and more, there's more and more talk about 3 before the end of the year. I think we get 2.
Well, there's an interesting
So they
dynamic.
meet late October. They skip
Okay.
November.
Okay.
There's an interesting dynamic going on here. The Fed governors are positioning themselves to be the next Fed chairman. Like you're seeing this happen because Powell's going to be gone in May, regardless, if not sooner. So you had 2 dissenters for the first time in since 1993.
Yeah.
And that was the first time since 1993, which is a long time. So we're starting to see. That's why I think there's no way there's not a cut.
Yeah.
Right, because you had 2 dissenters then, and of course it should be more this way this time. But the interesting part is going to be the language that not just what Jerome Powell says, because his voice is going to start getting muted because his time is coming up. Right, it's coming to an end. It's just going to be interesting to see the people vying for that chairman position. And kind of paying attention to the front runners, and there's 4 of them right now. It's just interesting.
They're all starting to smell like politicians.
They are, right? They're all
Sadly.
trying to,
It's-
to do what Trump wants them to do. They're all trying to get appointed because of that. So
Yeah.
it'll be interesting to hear the remarks from not just the chairman, but others.
And I hope I'm wrong. I mean, not that I hope I'm wrong, because I think it's fairly short-lived no matter what happens. But I think the market sells off regardless.
Yeah. If they do nothing,
If they don't cut, if they cut, or if they cut by 50, I think the market sells off.
I think
just
50
because,
is a positive. I think 50 is a positive because I think they should have been cutting already. And I think 50 just gets us where we should be.
No,
that's-
I kind of agree with that, but I think very short term. It may not be more than a day or 2, but I think it spooks the market because
Yeah.
it's kind of that, oh crap, what
Makes
do
it
we
look
not
like
know?
we're going into a recession or
Yeah,
something.
like
right?
is the labor market just? I mean, you can see labor market's soft. It's not in a good spot, and
Yeah.
it's like
they do have every bit of ammo they need now to cut.
Yeah.
And I think Powell's last comments, I mean, he really spoke to that. It may have been at Jackson Hole where, he basically said, yes, we have a dual mandate. One is inflation, but the other one's labor. And
Yeah.
there's some trouble on the labor front. It is softening.
well, you compound AI and the efficiencies that are coming from AI, because we're in the part of this AI cycle
We're in
where
the
it's-
beginning stages.
but we're far enough into it where there's the use cases are starting to be developed and understood. So, a few years ago it was like AI was all everyone was talking about, but nobody knew how to use it. Like there weren't any jobs being not replaced, or and now we're kind of at the point where it's like, I mean, here at the firm we're using it for various reasons and looking at new ways we can use it. And so you compound that on top of a kind of a naturally, a natural part of the labor cycle that's soft for other reasons. And it's tough, for people out there, especially those first-time job seekers trying to get a first job out of college or.
Yeah, I think that since 2020 we have printed money, we have inflation that's crazy from COVID, from the printing of money, from you could say tariffs, but I'm not sure that's even the biggest part of this. But you've had all this happen for 4 or 5 years, and then they say that the inflation rate's coming down, and the overall year, it's 2.4 or whatever it is. But they're not. It's kind of like we're not counting in the previous 4 years of massive inflation that is not coming down. So the point is, the younger folks, middle class and under, are still struggling to buy groceries and go on vacations, and that eventually seeps into the economy. And then the other side, when you go around and you get a coffee at a local coffee shop or something, right? There are a lot of young people that are working that have college degrees that cannot find another job. They're off the labor report, but they're not working in the field.
They're underemployed.
They're underemployed. There's a lot of underemployment. Take out the immigration issue, which we've taken a lot of people out of the workforce, which is kind of skewing the numbers right now, and that's going to level off soon. There's a lot of things going on.
There are, and there's I think not all of it's bad.
Right,
all of it's hard in its own ways, just like working through it.
Yeah.
Some of it I think is necessary. But we're definitely going through this period of kind of a reset, whether it's from interest rate perspective, labor market perspective, with immigration and
it may not be a conversation for today, but one thing that we need to begin looking at is over the next 6, 12, 18 months, we are going to be in a period of lowering interest rates. I mean, many feel like, another 150, 200 basis points over the next year and a half. that affects investors, and where do we see that quickly? Savings rates, money market rates, CD rates will be quick to reprice. I mean, the Fed lowers rates on Wednesday, you will begin seeing banks changing their CD rates and savings rates that day. We may or may not see mortgage rates come down. They're more tied to the 10-year.
Yeah.
So you will see, getting back to our conversation earlier about how should I invest as I go into retirement, conservative clients who have been able to get nice bank yields, those days are coming to an end.
At the same levels. I don't think we're going back to this.
No,
the old regime. But yes,
correct.
I mean, 4 or 5+% on CDs and that's probably going to be in the 2.5 to 3.5% range.
Yeah, we're not going back to zero.
If you want to have some fun and you want to really get kind of upset at things, 2009 the Fed.
I mean, I don't. But
2008, 2009 the Fed took away the reserve requirement of banks, right? 10% reserve requirement, which people don't talk about. But it goes back to the new Fed that comes in. The pressure is probably going to be to put that back on. And the reason is, if you want to get really upset, look at how much interest our government, our tax dollar, are paying banks right now to leave money in the banks.
Yeah.
Because they're getting, some are at 40% reserve because they're getting 5% from the Fed. So there's a lot of stuff that is underneath the surface that we're not, that nobody's talking about on the news or whatever, because it's not fun, exciting news. But there's so much going on in the undercurrent with this Fed and the new Fed that's potentially coming, whatever, that there is a lot of things that battles we're going to be fighting. But I still feel positive about the future because of tax rates being, kind of settled. We know that's not going to go up. We know regulation is being kind of taken away, so we're seeing businesses able to start expanding more, which will lead to better job market. There's a lot of things that, like in the distant, you can see positive, right? But there could be some shaky stuff between now and getting there.
Yeah,
anyway,
absolutely.
And that's why these little tiny Fed meetings, we put so much pressure on them.
Oh yeah,
but they're not that.
Yeah,
honestly,
it's like we're talking about a quarter basis point. I mean, it's like
it's
not
that big a deal.
That's going to probably dictate what the market does the next 48 hours after that.
Exactly.
But like long term, like that shouldn't be a repricing moment for any kind of,
Yeah.
Anyways, good conversation. Hopefully you guys enjoyed it.
And I'm assuming that neither one of y'all won the Powerball.
We did not.
I did.
I would not be here this morning.
I did, but I'm just don't tell Kathy.
I'm kidding.
But
Okay.
I'm trying to get some things shuffled around before I tell her. But
Got it. Congratulations.
Wouldn't that be fun?
Yeah, I did not win the Powerball, but Missouri and Texas, I think, split
Two
it.
two
Missouri
winners.
and Texas.
Yeah.
Well, good. That's
Maybe
awesome.
they'll
Folks
find their
right
way to Mach 1.
there. Yeah, they're close. They're within range.
They are.
Ooh, hello,
They are.
hello.
Border states.
That's right.
Yeah.
Hopefully, they listen to exciting podcasts like this one. Anyway,
All right. Well, we appreciate you guys. As always, give us a like, subscribe, send us your comments or questions via email on the comment section. We always appreciate looking at those and responding. So we'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.